Two more Canadian banks reporting earnings this morning, BMO and Bank of Nova Scotia. We did see a bit of pressure on BMO at the open. That stock was down more than 2%. Down about 1.5% now. Bank of Nova Scotia holding its own. As of today, the bank stocks in Canada, not the broad financials, but the bank stocks themselves, down about 4% in 2023. But, of course, those famous dividends have eased the pain there. If you were in the bank index now, you were down about 0.8%. Well, let's get some more perspective on the banks. Philip Petursson joins us now, Chief Investment Strategist at IG Wealth Management. Great to see you.
Great to be here.
The banks, they have been reliable in the past, but what about the sector? Are you overweight, underweight?
Well, I think the banks are very attractive right now. And think of it this way. What we're looking at the banks is a residual effect of the rise in interest rates and the pressure on the consumer in Canada as well as in the United States. And so we're seeing loan loss provisioning increase by the banks. We're seeing earnings slow down as we've had out of the results. But this is all expected, given the macroeconomic environment that we're in right now. So I actually think the banks are attractive. They're attractively valued. As you point out, the dividends are still very, very strong. They continue to pay those dividends. There's no risk, in my mind, to those dividends. So with the mindset that the bad news is perhaps already priced in, anything better than the worst is actually good news.
That's interesting. Yeah, Bloomberg calculates, and there's different ways of doing it, the yield on the bank index at about 4.9%. And as you say, the bank executives would be loath to cut the payouts.
Exactly. I mean, that's the last thing they will do. What we're seeing out of the banks to mitigate some of the expense pressures that they're seeing is they're cost cutting. They're cost cutting through largely headcount, and I think that's going to continue. But they're doing the right things. They're increasing their loan loss provisioning, which we know they tend to over provision. So at some point down the road, they'll be able to repatriate some of that onto the income statement. And so this is, again, none of this is unexpected. And given the valuation, given what's already priced into the banks here with the dividend, they have potential, strong outperformance to the upside.
Even if they don't cut the dividend, though, on paper, I know this is a bit broken record-ish, but if the housing market finally goes into a major slump, those bank stocks will suffer, presumably.
Well, a little bit, but you have to think of the banks and their lines, their business lines. They're very well diversified across business lines. They're not just housing sector banks. They're involved in the capital markets. They're involved in businesses in Canada as well as the United States, so diversified by geography. Yes, I think the lending aspect to the banks will suffer in terms of loan growth, but I don't think they'll see significant losses. Immediately, people turn to 2008 and what happened in the United States. Well, our banks aren't the same, and our mortgages aren't the same. So I don't think there is as much risk that people would think.
In the past, without commenting on individual banks, there's been a dogs of the bank strategy. In fact, somebody has I think it's Hamilton ETFs have an ETF out there that'll sell the strongest bank and buy the weakest bank. Has that kind of strategy worked generally?
Well, historically, when you look at the banks, they tend to trade within a fairly tight valuation range. And you do get deviation from the top bank versus the cheapest bank. And yes, over time you have seen, if you rotate out of the fully valued bank into a cheaper bank, that, remember, these banks are oligopolies. Right, so they're pretty much homogeneous in a way. So you can get a valuation advantage by picking up the cheaper one and seeing just a modest re-rating back to average, which will deliver better performance than the sector.
And in some ways, you think the Canadian banks could be the anti-NVIDIA, the inverse.
Exactly. Look at what happened with NVIDIA last week. They came out and very, very strong results, and the stock didn't move on the day and is down since then. Why is that? Well, people were expecting the best news out of NVIDIA. That's what was priced into the stock, and that's what we got. So it's like, okay, well, what are you going to do for an encore? In this case, look at what's going on with Scotia today. They came out, they disappointed, and the stock's up. Why? Well, bad news, in a way, is good news because things can only get better from here. We should only be able to see improvement out of the banks from these levels.
Broadly, though, on the market, you'd be wary about putting new money to work in stocks right now, partly because of the seasonal period we're moving into.
Yeah, that's it. I think we want to be a little bit more discerning in terms of where we put our dollars and how quickly we allocate them. So September historically is the worst month of the year. Looking at the United States with data going back to the 50s, September has a greater probability of delivering a negative return for investors on the S&P 500. So that could present some buying opportunities like we saw last year. So what we're saying is don't be in a rush now. This say 5% pullback that we've seen on the S&P 500 could go deeper, and that could open up better buying opportunities than what we have today.
It's fascinating, isn't it? And then it has been reliable. That end of year rally, it generally has been pretty consistent.
Exactly. The Santa Claus rally. So the way it works is we tend to see September, October weaker. These months tend to disappoint or be, on the inverse, the good buying opportunity. When we see that volatility, that gives way to November and December, which historically are the strongest months of the year in terms of probability of upside as well as total return.
Are you overweight, just finally, are you overweight or underweight energy right now?
I would be starting to build a position into energy, building into an overweight position into it. What we see going forward for energy is a tight oil supply that could continue to push the price higher. The price has been fairly resilient at around that $80 range. That's helped with OPEC cuts. That's helped with the U.S. production. That's kind of stayed flat since COVID. But we know that demand is still there. So we could see the price for oil push higher over the course of the next, say, 18 to 24 months. And valuation in the energy sector is extremely attractive with, same like the banks, very, very strong dividends.